What if I told you that the secret to making money in the markets has almost nothing to do with your strategy? What if the perfect technical setup, the most brilliant fundamental analysis, and the fastest news feed are all practically worthless in the hands of the average person? It sounds like heresy, doesn't it? We spend thousands of hours and dollars searching for the perfect system, the holy grail indicator that will finally unlock consistent profits. Yet, the vast majority of people who try fail. They lose money, get frustrated, and quit, convinced the game is rigged. But what if the game isn't rigged? What if the flaw isn't in the market, but in our own minds? How can a person who is successful in every other area of their life, a doctor, an engineer, a business owner, get completely dismantled by the simple act of clicking buy and sell? The answer is psychology. And for decades, one book has served as a definitive guide to conquering the inner game of the market. A book that argues powerfully that success is not about predicting the future, but about achieving a state of mind where you're no longer vulnerable to fear, greed, and hope. Welcome to Capitura. Today, we are not looking at charts or balance sheets. We are looking in the mirror. We are taking an audiobook-style journey to the Bible of trading psychology, Trading in the Zone by Mark Douglas. This isn't a book about strategies. It's a book about you. It's about rewiring your brain to think in probabilities, to accept risk without fear, and to achieve the mindset of a professional trader. Stay with us, because the concepts in this book can fix your trading mindset forever. Introduction: the battlefield inside your mind. Mark Douglas wasn't a Wall Street guru with a famous hedge fund. He was a trading coach. But he didn't coach strategies. He coached minds. His career, which began in the early 1980s, was born from his own painful experiences as a struggling trader. Like so many, he started out thinking he could outsmart the market. He had the intelligence, the drive, and what he thought were good strategies, yet he kept losing money. He experienced the gut-wrenching frustration of a winning trade turning into a loser, the paralysis of being too scared to enter a perfect setup, and the recklessness of revenge trading after a loss. Through this process, he had a profound realization. His problem wasn't a lack of market knowledge. His problem was his own mental programming. The very beliefs and emotional habits that helped him succeed in everyday life were catastrophic in the market environment. Our brains are wired to avoid pain and seek certainty. But the market is an environment of constant uncertainty and potential for pain. This fundamental mismatch, Douglas realized, is the source of almost all trading errors. He wrote Trading in the Zone in 2000, and it quickly became an underground classic, passed from one trader to another like a secret text. Why does it remain so vital today in a world of high-speed algorithms, crypto, and meme stocks? Because the arena has gotten faster, louder, and more psychologically treacherous than ever before. Think about the modern trader. They are sitting at home, staring at a screen that provides a constant, second-by-second measure of their self-worth. They open Twitter and are bombarded with screenshots of huge wins, fueling a powerful sense of FOMO. They jump into a soaring cryptocurrency, not because their strategy told them to, but because they are terrified of being the only one to miss out on life-changing gains. They join a Reddit forum and get swept up in the narrative of a meme stock, like GameStop, believing they are part of a populist movement. Their decisions become driven by emotion, by a sense of belonging, and by the hope of a lottery ticket payoff, not by a cold, objective trading plan. This is the psychological battlefield of the modern market. Even for those not actively day trading, Douglas's lessons are critical. An investor trying to follow a long-term plan, perhaps as part of the FIRE movement, still has to endure brutal bear markets. They have to fight the urge to sell everything in a panic when their ETF portfolio is down 30%. That battle is not fought on a spreadsheet. It's fought in the gut. The discipline to stick to a plan in the face of fear is a psychological skill. Trading in the Zone provides the tools to win that battle. It's not about positive thinking or empty affirmations. It's a deep, systematic look at the mental architecture required for success. Douglas teaches you that the goal is not to predict the market's next move. The goal is to get your mind to a place where you genuinely don't care about the outcome of any single trade. It's about achieving a state of carefree confidence, where you can execute your strategy flawlessly without fear or hesitation, because you have trained yourself to think in probabilities just like casino. This book is the bridge from being an amateur gambler to a professional risk manager. It will challenge your most fundamental beliefs about the market and about yourself. In the chapters that follow, we will break down Mark Douglas's core concepts. We'll explore why we are naturally wired to fail in the markets, how to take true responsibility for our results, and how to build the 5 fundamental truths of a probabilistic mindset. And after each chapter, we will connect these profound psychological insights to the real-world pressures and temptations you face as a trader or investor today. This is your masterclass in the psychology of peak performance. Let's begin. Chapter by chapter breakdown. Chapter 1. The Road to Success. Fundamental, Technical, or Mental Analysis. Mark Douglas begins his book by addressing the central question that every aspiring trader asks. What do I need to learn to be successful? He breaks down the world of market analysis into 3 distinct categories, creating a roadmap for the journey ahead. The first is fundamental analysis. This is the study of the underlying economic forces that can affect the price of security. For a stock, a fundamental analyst would look at a company's earnings, revenue, debt levels, management quality, and competitive position. For a currency, they would analyze interest rates, inflation, GDP growth, and political stability. For a commodity, they would study supply and demand dynamics. Fundamental analysis seeks to determine a security's intrinsic value, based on the belief that the market price will eventually converge with this value. The problem, Douglas points out, is that this approach says very little about when the price will move. A stock can remain undervalued for years, and a trader can go broke waiting for the market to agree with their analysis. The second is technical analysis. This approach is not concerned with the why behind price movements. Instead, it focuses entirely on the what. Technical analysts study historical price charts, looking for patterns, trends, and recurring human behavior. They use indicators like moving averages, trend lines, and oscillators to identify moments when a market is likely to move in a particular direction. Technical analysis is based on the premise that all known information is already reflected in the price, and that human psychology causes prices to move in predictable, repeating patterns. This is the dominant form of analysis for short-term traders. However, Douglas notes a critical problem here as well. Why do 2 traders, looking at the same chart and the same perfect technical setup, often have completely different results? Why does one make money while the other loses? This leads him to his third and most important category, mental analysis. This is the core of the entire book. Douglas argues that even with the best fundamental or technical analysis in the world, most traders will fail because they lack the proper psychological framework. They bring a set of beliefs and emotional responses to the market that are completely at odds with the way the market actually works. He tells the story of his own early career, where he had access to what he believed was a winning strategy, yet he consistently lost money. He discovered that the true Holy Grail was not a secret indicator or a perfect system. It was a particular state of mind. He concludes that while both fundamental and technical analysis have their place, they are useless without a mastery of one's own psychology. The ultimate edge in trading comes from the inside. It comes from developing a mindset of discipline, objectivity, and emotional control. You can have a mediocre strategy and still make money if your mindset is strong, but you can have the best strategy in the world and still lose money if your mindset is weak. This first chapter sets the stage for everything that follows. It shifts the reader's focus away from the external, the market, the charts, the news, and directs it inward to the only thing they can truly control, their own mind. Modern takeaway. This 3-part framework is a perfect lens for viewing the modern market landscape. Today, fundamental analysis is a domain of long-term investors like Warren Buffett, but it's also practiced by retail investors trying to find the next great growth stock like Tesla. They pore over financial statements and build complex models. Technical analysis is the language of the modern-day trader. It dominates YouTube, Twitter, and every trading chat room. People draw lines on charts of everything from the S&P 500 to Bitcoin and Dogecoin, looking for the same patterns Douglas describes. But it's mental analysis that is most crucial in today's hyper-stimulating environment. Think about the Robinhood culture. A new trader is armed with a simple app and access to an endless stream of technical setups from social media. They see a pattern, they place a trade, and they win. The app showers them with digital confetti. This creates a powerful dopamine hit. The problem is, they haven't developed the mental framework to handle the inevitable losses. When a trade goes against them, they are psychologically unprepared. They freeze, they revenge trade, they blow up their account. They blame the manipulators or the algorithm. But Douglas would say the real problem was their complete lack of mental analysis. They learned a few chart patterns, but they never learned how to manage their own fear and greed. This chapter's lesson is profound. Stop searching for the perfect strategy and start working on your own mind. That is where the real work and the real profits are found. Chapter 2, The Lure and Dangers of Trading. In this chapter, Douglas explores the powerful psychological forces that draw people to trading and the hidden dangers that keep them trapped in a cycle of failure. He argues that the market is an environment of unlimited potential for both profit and loss, and this freedom is both its greatest attraction and its greatest pitfall. In most areas of life, there are rules, structures, and limits that govern our behavior. At a job, your boss tells you what to do. In a game, there are clear rules and boundaries. But in the market, you are the boss, the player, and the referee all in one. You can buy or sell whenever you want, risk as much as you want, and hold for as long as you want. This absolute freedom is exhilarating. But it is also terrifying because it means we are solely responsible for our own results. Douglas explains that the market's primary danger is its ability to provide random rewards. A beginner can place a trade with absolutely no skill or strategy, purely on a whim, and end up with a huge winning trade. This is incredibly dangerous. The human brain is not good at processing randomness. When we get a positive result, we automatically assume our actions caused it. The beginner who wins big on their first few trades is immediately filled with a sense of euphoria and confidence. They feel like a genius. They believe they have figured out the market. This creates a powerful psychological addiction, much like a gambler hitting the jackpot on their first pull of a slot machine. They are now conditioned to expect easy money and are completely unprepared for the reality of the market. This leads to the cycle of pain that most traders experience. After those initial easy wins, they start to lose. But because their confidence is so high, they can't accept that they might be wrong. They refuse to take small losses, convinced the market will come back. They average down, adding to a losing position. They revenge trade, trying to win back what they've lost. They are no longer trading their strategy. They are trading their emotions. Every tick against them becomes a source of intense emotional pain. They get angry at the market, they feel betrayed, and they eventually blow up their account. Douglas argues that this happens because we come to the market with expectations that are out of sync with reality. We expect the market to give us what we want, and we feel pain when it doesn't. We fail to understand that the market owes us nothing. It is an impersonal force, and its only job is to provide opportunities. It is our job to develop the mental skills to take advantage of them, without getting emotionally destroyed in the process. Modern takeaway. The modern market environment has turned the lure and dangers Douglas described into a high-speed, global phenomenon. The meme stock craze of 2021 is a perfect case study. Thousands of new traders, armed with stimulus checks and commission-free apps, piled into stocks like GameStop, GME, and AMC. Many had no strategy or experience. They bought simply because it was the popular thing to do. Some of them made life-changing amounts of money in a matter of days. This was the ultimate experience of a random reward. It created an entire generation of traders who believed that the stock market was a get-rich-quick machine. The same dynamic plays out constantly in the cryptocurrency markets. A person buys a new altcoin based on a tip from a TikTok influencer, and it goes up 1,000% in a week. They are instantly hooked. They feel invincible. But they have learned a dangerous lesson, that you can make a fortune with zero effort or analysis. When the inevitable crypto winter arrives, and their portfolio crashes 90%, they are psychologically devastated. They don't understand what happened. They were conditioned by random rewards to expect only upside. Douglas would say that the modern market, with its viral trends and instant access, has become the world's largest and most efficient machine for delivering random rewards, and therefore, for creating psychologically damaged traders. This chapter is a warning. Be deeply suspicious of your early, easy wins. They are often the most expensive lessons you will ever learn. Chapter 3, Taking Responsibility. This chapter is a turning point. It's where Douglas separates the traders who have a chance of succeeding from those who are doomed to fail. The central theme is a concept of taking absolute and complete responsibility for the outcome of your trading. This sounds simple, but Douglas argues it's one of the hardest psychological shifts for a trader to make. He explains that most losing traders are stuck in a mindset of blame. When a trade goes wrong, they have a long list of external factors to blame. Their broker filled them late, their news feed was slow, a whale manipulated the price, the market makers are hunting their stops, the algorithms are rigged. The list is endless. By blaming the market, they create a temporary shield against the emotional pain of being wrong. The problem is, this shield also prevents them from learning and growing. If the market is always at fault, then there is nothing they need to change about themselves. They are a victim of an external force, and as long as they see themselves as a victim, they are powerless. Taking responsibility, in Douglas's view, means accepting that your trading results are a direct reflection of your own skills, your own mindset, and your own beliefs. It means acknowledging that you are the one who chose to enter the trade, you are the one who decided how much to risk, and you are the one who chose when to exit. The market didn't make you lose money. You lost money because your strategy or your execution was flawed. This is not about self-blame in a negative way. It's about empowerment. The moment you take responsibility, you give yourself the power to change. If your results are a product of your own mindset, then you can change your mindset and therefore change your results. This shift has a profound effect on your perception. A trader who takes responsibility no longer sees the market as an adversary. They see it simply as a neutral source of information. A losing trade is no longer a personal attack. It is simply feedback from the market that their edge was not present at that moment. It's a data point, an opportunity to learn and refine their approach. Douglas says that the best traders have created a mental framework where they have eliminated the concepts of blame and fault entirely. They know that they are responsible for everything, and this allows them to operate in a state of objectivity and emotional freedom. They are not trying to be right. They are simply trying to be profitable, and they know that the only path to profitability is through continuous self-improvement, which can only begin when you take 100% responsibility for your actions. Modern takeaway. The culture of blame has been amplified by the internet. Go into any stock market chat room or social media thread after a big market drop, and you will see it in action. People are not analyzing their own mistakes. They are screaming about crime, manipulation, and hedgies. The AMC and GameStop communities, for example, have built an entire narrative around the idea that any price decline is a result of a vast conspiracy by hedge funds. While market mechanics can be complex, this mindset is exactly what Douglas warns against. It creates an external enemy and absolves the individual of the responsibility to manage their own risk. Similarly, in the crypto world, when a project collapses, the community often blames FUD, fear, uncertainty, and doubt, spread by outsiders, or a single large seller, a whale dumping on us. They rarely engage in self-reflection about the risks they took or the flaws in their own analysis. Douglas would argue that as long as these communities are focused on external blame, they will never develop the collective mindset needed for consistent success. The lesson of this chapter is a tough pill to swallow, but it is liberating. The next time you have a losing trade, resist the urge to blame anything or anyone. Look in the mirror and say, I chose to take this trade. I am responsible for this result. What can I learn from it? That simple act is the first giant leap toward becoming a professional trader. Chapter 4, Consistency, a State of Mind. In this chapter, Douglas addresses the ultimate goal of every trader, consistency. He argues that consistency is not the result of a perfect trading system or a magical indicator. Consistency is a state of mind. It is a psychological outlook that allows a trader to execute their plan without emotional interference, day in and day out. He begins by dissecting why most traders are wildly inconsistent. They have a few great winning trades, followed by a devastating loss that wipes out all their gains and then some. This boom and bust cycle is a direct result of a flawed mental state. The trader is operating from a perspective of fear. They are afraid of losing money. They are afraid of missing out. and they are afraid of being wrong. This fear is the root cause of the most common trading errors. Hesitating to enter a valid trade because of a previous loss. Jumping the gun and entering a trade too early out of fear of missing the move. Cutting a winning trade short out of fear of giving back profits. Letting a losing trade run out of the hope that it will turn around, because taking a loss would mean admitting they were wrong. All of these errors are driven by an emotional reaction to the market's immediate behavior. The trader is thinking about the outcome of the single current trade rather than the statistical outcome of a series of trades. Douglas argues that to achieve consistency, you must fundamentally change your perspective. You must learn to think in a way that keeps you immune to these emotional pressures. The key to this is to create a mental state of carefree confidence. This is not arrogance or recklessness. It is a deep, unwavering trust in your trading edge and in yourself to execute that edge flawlessly over time. A trader in this state of mind is not concerned with whether any individual trade is a winner or a loser. They know that their edge gives them a higher probability of success over a large sample of trades. And that is all that matters. They accept the risk of each trade without fear because they have predefined their loss and know it is just a normal part of the business. They execute their plan like a machine because their self-worth is not tied to the outcome of any single event. Douglas makes it clear that this state of mind does not come naturally. It must be actively and consciously built. It requires a deep understanding of the market's probabilistic nature and a complete acceptance of the risks involved. You cannot be a consistent winner if you're still trying to avoid losses or trying to be right on every trade. You must train your mind to see the market as a stream of probabilities, not a series of threats and opportunities. Consistency in your results can only come from consistency in your mindset. Modern takeaway. The modern market, with its 24/7 news cycle and social media chatter, is an engine of inconsistency. It constantly pulls traders out of their plan and into an emotional, reactive state. Think about a trader trying to follow a rules-based strategy for trading Tesla stock. 1 minute. A news headline flashes about a production delay, and the stock drops 5%. The trader panics and sells, violating their plan. An hour later, Elon Musk posts a cryptic tweet, and the stock rips 10% higher. The trader, full of regret and FOMO, buys back in at a higher price, again violating their plan. They are being whipsawed by the narrative of the day, completely detached from their own strategy. Their results will be random and chaotic. The concept of a carefree confidence is the antithesis of this. It's the mindset of a professional poker player. The pro doesn't get emotional when they lose a big hand with pocket aces. They know that in the long run, playing pocket aces is a winning strategy. The single outcome is irrelevant. The process is everything. A modern trader must cultivate the same mindset. They must have such deep confidence in their tested strategy that they can ignore the news, ignore the tweets, and ignore the talking heads on TV. They simply wait for their edge to appear and then execute their plan, regardless of the noise. This chapter teaches us that consistency is not about finding a system that never loses. It's about building a mind that is not afraid to lose. Chapter 5, The Dynamics of Perception. This chapter goes deep into the mechanics of how our minds process information and why this natural process is so dangerous in the trading environment. Douglas's core argument is that we do not perceive reality directly. Instead, our minds are constantly filtering and interpreting external information based on our pre-existing beliefs, memories, and emotional state. In essence, we don't see the market as it is. We see the market as we are. He explains that our minds are designed to be efficient. To avoid being overwhelmed by the billions of bits of information we encounter every second, our brains create mental models and belief systems. When new information comes in, our mind tries to fit it into these existing models. Information that confirms our beliefs is easily accepted. Information that contradicts our beliefs is often ignored, distorted, or rationalized away. This is the mechanism behind confirmation bias. In everyday life, this process is often useful, but in the market, it is a recipe for disaster. Let's say a trader believes that a particular stock is going to go up. They have done their research and have a strong conviction. Now, they're watching the price action. Any small move up will be seen as confirmation that they are right. Any move down will be seen as noise, a shakeout, or a temporary pullback before the real move begins. Their mind is actively filtering reality to match their belief. They are no longer objectively observing the market's information. They are projecting their own desires onto it. Douglas also discusses how our emotional state dramatically affects our perception. When we are feeling confident and optimistic, we are more likely to perceive bullish signals in the market. When we are feeling fearful and pessimistic, perhaps after a series of losses, we are more likely to perceive bearish signals. The market hasn't changed, our internal filter has. This is why a trader can look at a chart in the morning and see a clear buy signal. But if they hesitate and become fearful, they can look at the exact same chart an hour later and see a dozen reasons not to buy. The goal of a trader, Douglas says, is to learn how to perceive the market's information in the most objective, unbiased way possible. This requires stripping away the emotional filters and the need to be right. It means learning to see the market as a neutral flow of information about what is happening right now, in this unique moment. You cannot control what you perceive, but you can control your beliefs and attitudes, which in turn shape your perceptions. The professional trader has learned to decouple their internal state from the market's external behavior. Modern takeaway. The modern information environment is a confirmation bias machine on steroids. Our social media feeds, our news sources, and our YouTube recommendations are all driven by algorithms designed to show us more of what we already like and believe. This creates powerful echo chambers and filter bubbles. Consider the world of Bitcoin. If you are a strong believer in Bitcoin, a maximalist, your Twitter feed is likely filled with other maximalists. You see charts showing its long-term upward trajectory, news stories about institutional adoption, and memes mocking its critics. This creates a powerful subjective reality where the success of Bitcoin seems inevitable. Contradictory information, like warnings about regulatory crackdowns or environmental concerns, is dismissed as FUD. Your perception of the market's information is being heavily filtered by your belief system and your information bubble. The same is true for a Tesla bull or a Tesla bear. Each side consumes information that confirms their existing narrative, and they genuinely cannot understand how the other side sees the world. Douglas would say that neither of them is seeing the market objectively. They are both seeing a reflection of their own beliefs. This chapter is a call for radical self-awareness. You must understand that your perception of the market is not the objective truth. It is a subjective interpretation. The professional trader's job is to constantly question their own perceptions and strive to see the market for what it is, an endless stream of opportunities, free of any meaning other than what we assign to it. Chapter 6. The Market's Perspective. In this chapter, Douglas asks the trader to perform a crucial mental shift, to stop looking at the market from their own individual perspective and start looking at it from a market's perspective. From our individual point of view, the market can seem chaotic, malicious, and personal. It feels like it knows where our stop loss is. It feels like it waits for us to buy before it drops. We see it as an entity that is either helping us or hurting us from the market's perspective. However, none of this is true. The market is simply the collective action of millions of participants, all acting in their own self-interest based on their own unique beliefs about the future. The market has no memory of what you did yesterday. It has no opinion on your position. It doesn't know you exist. It is a completely impersonal force. Its sole function is to facilitate trades and to move price to the level where the next buyer and seller are willing to transact. Douglas explains that the market is always providing information about itself in the now moment. The current price is the most important piece of information, as it represents a real-time consensus of value among all participants. Everything else, our hopes for the future, our regrets about the past, is a mental projection. The trader who is in tune with the market's perspective is focused entirely on what is happening right now. They are not angry that the market didn't do what they expected it to do. They are not hopeful that the market will do what they want it to do. They are simply observing the flow of price and volume and looking for opportunities where their edge is present. This perspective helps to neutralize the emotional charge of trading. If the market is not against you, then a losing trade is not a personal failure. It is simply the result of the collective force of the market moving in a direction that was contrary to your position. By adopting the market's perspective, You start to see yourself not as a single individual battling a giant, but as a small part of a larger stream. Your job is not to predict where the stream will go, but to find a low-risk point to enter, ride the current for a while, and then get out. This mindset allows you to see both sides of the market at all times. You understand that at any given moment, there are traders who are bullish and traders who are bearish. The price is simply the result of their ongoing battle. This removes the need to be right. You are no longer trying to prove that your belief about the future is correct. You are simply trying to align yourself with the dominant force in the market at that particular moment. Modern takeaway. The idea of the market's impersonal nature is a powerful antidote to the narrative-driven markets of today. Social media creates intense, emotionally charged stories around assets. The GameStop saga was not just about price. It was a story of apes versus hedge funds, a battle of good versus evil. A trader caught up in this narrative sees the market as a deeply personal battlefield. Every downtick is a criminal attack by hedgies. Douglas would say this is a fatal perspective. It forces a trader to view all information through the lens of their story, making objective decision-making impossible. Similarly, an investor in a specific cryptocurrency often becomes part of a community or a tribe. They see their chosen coin as a world-changing technology and view other coins as inferior or as scams. They are personally invested in the success of their team. The market, however, does not care about any of this. It is simply processing buy and sell orders. A trader who can step back and adopt the market's perspective can see these narratives for what they are, powerful psychological forces that create opportunities, but not objective realities. They can trade the hype around a meme stock without having to believe in the story. They can trade the volatility of a cryptocurrency without being a true believer. This chapter teaches us to depersonalize the market. It's not about you. It's just a flow of information. By aligning yourself with this neutral perspective, you can free yourself from the emotional grip of the narratives that trap so many modern traders. Chapter 7, The Trader's Edge, Thinking and Probabilities. This is the absolute core of the book, the central pillar upon which Mark Douglas's entire philosophy rests. If you understand this chapter, you understand trading in the zone. Douglas argues that the single biggest difference between a professional trader and a struggling amateur is that the professional thinks in probabilities. The amateur trader thinks in a trade-by-trade, right or wrong paradigm. Every trade is a test of their intelligence and skill. If the trade is a winner, they are a genius. If it's a loser, they are a failure. This mindset makes every trade an emotionally charged event, a battle for self-worth. It is completely unsustainable. The professional trader, on the other hand, has made a profound mental shift. They have accepted two fundamental truths about the market. Anything can happen. No matter how perfect the setup looks, there is always a chance it will fail. The market is a realm of uncertainty. You don't need to know what will happen next to make money. You only need an edge. An edge is nothing more than a higher probability of one thing happening over another. A trading strategy might be right 60% of the time and wrong 40% of the time. This is a powerful, winning edge. The professional trader understands that their edge will only play out over a large sample size of trades. The outcome of any single trade is random and meaningless. You could have 4 losing trades in a row and still have a winning system. You could have 4 winning trades in a row and still have a losing system. This is where Douglas introduces his famous analogy of the casino. A casino does not know whether the next spin of the roulette wheel will be red or black. The outcome of any single spin is random, but the casino doesn't care. They know that over thousands of spins, the extra 0 and 0 on the wheel give them a small statistical edge. They will always be profitable over the long run, regardless of the outcome of any individual spin. The casino operates in a state of complete certainty about its long-term success, despite the complete uncertainty of the next event. This is the mindset the trader must adopt. You must think of your trading strategy as your own personal casino. You must have a rigorously tested edge, and you must have absolute confidence in that edge. Then, you must commit to executing that edge over a large enough sample size. Douglas suggests a minimum of 20 trades, to let the probabilities play out. When you think this way, the emotional significance of any single trade disappears. A losing trade is no longer a source of pain. It is simply a part of the 40% of the time that your edge didn't work. It's a normal, expected business expense, just like the casino paying out a jackpot. A winning trade is not a source of euphoria. It is simply the 60% of the time that your edge worked. This mindset allows you to trade without fear, hesitation, or emotional turmoil. You are no longer predicting. You are executing. Modern takeaway. The modern market, with its instant gratification and focus on single events, is the enemy of probabilistic thinking. The entire culture of YOLO trades, you only live once, on Wall Street bets is a polar opposite of this chapter's wisdom. A YOLO trade involves betting a huge portion of your account on a single high-risk event, like a company's earnings report or a drug trial result. This is a right or wrong approach in its most extreme form. The trader is not thinking about a sample size. They are thinking about one spin of the wheel. Similarly, a new trader who gets into crypto options or leverage futures is often operating in this paradigm. They are swinging for the fences on every trade, hoping for a 10x return. When the trade goes against them, they are emotionally and financially wiped out. They haven't learned to think like a casino. A modern trader applying Douglas's principles would approach the market very differently. They would have a clearly defined strategy. For example, buying a specific technical breakout pattern on a major stock like Nvidia. They would backtest a strategy to confirm it has a positive expectancy, e.g., it wins 55% of the time, and the average win is larger than the average loss. Then, they would commit to taking the next 20 signals that the strategy generates, risking the same small percentage of their account on each trade. They would meticulously record the results in a journal. During this process, they would focus only on flawless execution. They would not care if the first 5 trades are losers. They would trust the process and let the probabilities work in their favor over the sample size. This disciplined, process-oriented approach is worlds away from the emotional gambling that characterizes so much of modern retail trading. Chapter 8. Working with your beliefs. Having established the importance of thinking in probabilities, Douglas now gets into practical work of how to actually change your mind to think that way. He argues that our behavior is driven by our beliefs, and many of the beliefs we hold are counterproductive in the trading arena. The goal of this chapter is to identify our limiting beliefs and systematically replace them with new beliefs that are aligned with the realities of the market. Douglas explains that our beliefs act as a powerful force, shaping our perception of information and creating our subjective experience of reality. If you have a belief that the market is a dangerous and scary place, you will perceive every tick of the price chart as a potential threat. This will trigger a fear response, making objective decision-making impossible. If you have a belief that you are not good enough to be a successful trader, you will subconsciously find ways to sabotage yourself to prove that belief true. The process of change starts with self-awareness. You must become an objective observer of your own thoughts and emotions while you are trading. When you feel fear, what specific thought or belief is causing it? When you feel greed, where is that coming from? Douglas suggests that many of our trading problems stem from a few core, flawed beliefs. The need to be right, the need to avoid losses at all costs, the belief that the market should give us what we want. To overcome these, we must consciously and deliberately install a new set of beliefs. Douglas proposes that the foundation of a trader's belief system should be what he calls 5 fundamental truths. Anything can happen. You don't need to know what is going to happen next in order to make money. There is a random distribution between wins and losses for any given set of variables that define an edge. An edge is nothing more than an indication of a higher probability of one thing happening over another. Every moment in the market is unique. These 5 truths, if fully internalized, act as a powerful antidote to fear and emotional trading. If you truly believe that anything can happen, you will never be surprised or angered by an unexpected market move. If you truly believe that you don't need to know the future, you will stop trying to predict it and focus on executing your edge. If you truly believe in a random distribution of wins and losses, you will stop getting euphoric after win or depressed after loss. And if you truly believe that every moment is unique, you will stop projecting the outcome of your last trade onto your next one. Douglas emphasizes that this is not a quick fix. You cannot simply read these truths and expect your behavior to change. You must actively work to install them as your core operating beliefs through conscious effort, repetition, and a commitment to trading in a way that is consistent with them. Modern takeaway. The modern market constantly reinforces the very beliefs Douglas tells us to discard. The financial media is a machine for creating the illusion of certainty. Pundits on TV make bold predictions about where the S&P 500 will be at the end of the year. Analysts put precise price targets on stocks like Apple. This entire ecosystem encourages a belief that the future is knowable and that our job is to predict it correctly. Douglas would say this is a dangerous fantasy. Social media platforms like Twitter and Reddit are also breeding grounds for limiting beliefs. They create tribes and echo chambers where specific narratives become articles of faith. A trader in a crypto community might develop the belief that holding on for dear life, HODL, is always the right strategy and that selling is a sign of weakness. This belief will prevent them from cutting a loss, even when objective evidence suggests their position is catastrophic. Their belief system has become rigid and is no longer serving them. A modern trader working on their beliefs might use techniques like journaling to identify their emotional triggers and the thoughts behind them. After a bad trade, instead of just feeling angry, they would write down, "I felt angry because I believed the market had to go up, and it didn't. This violated my belief that I can predict the market." Through this process, they can start to see how their flawed beliefs are driving their flawed actions. They can then consciously choose to focus on the 5 fundamental truths, perhaps even writing them down and keeping them on their desk as a constant reminder to stay in a probabilistic mindset. Chapter 9. The Nature Beliefs. In this chapter, Douglas goes even deeper, exploring the very nature of our beliefs and how they function. This is less of a how-to chapter and more of a conceptual foundation for the work that needs to be done. He explains that beliefs are not just fleeting thoughts. They are powerful, energized structures of consciousness. A belief is essentially a concept or idea that we accept as an absolute truth about the nature of reality. He makes a fascinating point. Beliefs are not born into us. They are acquired. We get them from our parents, our culture, our education, and our personal experiences. Once a belief is formed, it takes on a life of its own. It actively seeks out evidence in the environment that confirms its own existence and filters out evidence that contradicts it. For example, if a child is repeatedly told they are clumsy, they will form a belief in their own clumsiness. They will then start to notice every time they drop something, confirming belief, and ignore all the times they don't. The belief creates a self-reinforcing loop. Douglas explains that our beliefs generate our emotions. The external world is neutral. It is our belief about an external event that creates our emotional response. If you believe that snakes are dangerous, seeing a snake will trigger fear. If you grew up in a culture where snakes are revered, seeing one might trigger a feeling of joy or respect. The snake is the same. The belief is different. This is directly applicable to trading. The market's price action is just neutral information. It is our belief about that information that causes us to feel fear or greed. If you believe that a losing trade means you are a failure, then a losing trade will generate intense emotional pain. If you believe that a losing trade is a normal and expected business expense, it will generate little to no emotional response. The most powerful insight in this chapter is that all beliefs can be changed. Since we weren't born with them, we can choose to discard the ones that no longer serve us and install new ones. This is the essence of personal growth and the key to becoming a successful trader. It is a process of consciously examining our mental software, identifying the bugs, the limiting beliefs, and rewriting the code. Douglas is empowering the reader, telling them that they are not stuck with their current mindset. They have the power to create a new one, a mindset that is perfectly aligned with the probabilistic nature of the market. This requires effort and focus, but it is achievable. Modern takeaway. This exploration of beliefs is incredibly relevant to understanding the tribalism of modern markets. Think about the intense belief systems that have formed around different assets. The Bitcoin maximalists hold a core belief that Bitcoin is the only true decentralized currency and that all other altcoins are inferior scams. This belief is so strong that it shapes their entire perception of the crypto landscape. The Tesla bulls hold a core belief in the genius of Elon Musk and the inevitable dominance of the company. These are not just investment theses. They have become powerful, identity-defining beliefs. Douglas would say that these strong belief systems can be very dangerous for a trader. They create massive blind spots. A trader who believes that crypto is the future might be psychologically incapable of taking a short position, even when the technical evidence is overwhelmingly bearish. Their belief system filters out that possibility. A trader who believes that a certain meme stock is destined for the moon because of a grand conspiracy will be unable to see the objective business reality, that the company is failing. The work of a modern trader is to become aware of these powerful narratives and to consciously decide which beliefs they want to adopt. They must ask themselves, does my belief in this asset serve my goal of being a profitable trader, or does it serve my need to belong to a group or to feel like I'm part of a movement? The professional trader's only belief system is the 5 fundamental truths. Their loyalty is not to a stock or a coin, but to the principles of probability and disciplined execution. Chapter 10. The Impact of Beliefs on Trading. In this chapter, Douglas connects the dots, showing exactly how our underlying beliefs translate into concrete, real-world trading results. He breaks down the process. Our beliefs shape our perceptions. Our perceptions create our emotional state, and our emotional state dictates our behavior. The final outcome, profit or loss, is a direct result of this internal chain reaction. He uses a powerful analogy to illustrate this. Imagine a trader who has a deep-seated fear of being wrong. This fear is a belief system. When this trader enters a position, their mind immediately begins to interpret all market information as a potential threat to their need to be right. If the market moves against them by even a few ticks, their belief is threatened. This triggers an emotional response, fear. The fear then causes them to behave erratically. They might do one of several self-destructive things. Freeze. They become paralyzed and unable to act, even when their plan tells them to exit. Exit prematurely. They close the trade at the first sign of trouble, not giving their edge a chance to work, just to avoid the pain of being wrong. Widen their stop loss. They move their exit point further away, giving the losing trade more room to run, because they cannot accept the finality of taking the loss. In all these cases, the trader's behavior is being dictated by their belief system, not by their trading plan. The market is not the problem. The internal conflict between their desire to make money and their belief that they cannot afford to be wrong is the problem. Douglas then contrasts this with a trader who has successfully installed a belief system based on probabilities. This trader believes that losses are a normal part of the game and that their edge will play out over time. When this trader enters a position and the market moves against them, their belief system is not threatened. They perceive the information neutrally. There is no emotional charge or fear. Therefore, they can behave rationally and objectively. They simply follow their predefined plan and exit the trade at their stop loss with no hesitation or emotional pain. Their beliefs are in harmony with the realities of the market, which allows them to act in their own best interest. The key insight is that our beliefs act as a gatekeeper to what we are able to achieve. You cannot be a consistently profitable trader if you are holding beliefs that are inconsistent with that outcome. You cannot achieve a state of carefree confidence if you believe that every trade is a life or death battle. The market is a mirror that reflects our internal beliefs back at us in the form of our P&L statement. To change a reflection, you must first change what is inside. Modern takeaway. This direct link between beliefs and results is on display every day in modern markets. Consider the phenomenon of diamond hands in the meme stock and crypto communities. This is the belief that one must never sell, no matter how far the price drops. This belief, when it becomes a rigid identity, has a direct and often catastrophic impact on trading results. A trader who diamond hands a stock like MC from $60 all the way down to $5 is not acting on a rational trading plan. They are acting on a belief, a desire to be part of the tribe, and not be seen as a paper-handed trader. Their belief system is directly causing their financial loss. Another modern example is the belief in buying the dip. This can be a valid strategy for long-term investors in broad market ETFs. But for a trader, it can be a dangerous belief. A trader who believes that every dip is a buying opportunity will continue to add to a losing position in a crashing asset, like a speculative tech stock or a failing cryptocurrency. They are not responding to the market's information. They are responding to their belief. Douglas would say that their results are predetermined by this flawed belief. The work for a modern trader is to look at their trading journal and connect their worst results to their underlying beliefs. I lost a lot of money on that trade because I refused to take my stop loss. Why? Because I have a belief that good stocks always come back. By identifying this faulty connection, they can begin the work of dismantling that belief and replacing it with one of the 5 fundamental truths. Anything can happen. Chapter 11, Thinking Like a Trader. This final chapter is a synthesis of everything that has come before. It is the culmination of the journey, where Douglas lays out the integrated, holistic mindset of a professional trader. Thinking like a trader is not a collection of tips or tricks. It is a complete transformation of one's mental architecture. Douglas outlines the 7 principles of consistency that define this new way of thinking. I objectively identify my edges. The trader has a clearly defined, tested system for identifying opportunities. It is not based on guesswork or emotion that I predefine the risk of every trade. Before entering any trade, the trader knows exactly how much they are willing to lose and where their exit point is. The risk is always limited and managed. That I completely accept the risk and I am willing to let the trade go. This is a psychological leap. The trader is at peace with the fact that they could lose on this trade. There is no emotional resistance to the risk. I act on my edges without reservation or hesitation. When the trader system gives a signal, they act immediately. There is no second guessing or fear-induced paralysis that I pay myself as the market makes money available to me. The trader has a plan for taking profits. They are not greedy, trying to squeeze every last penny out of move. I continually monitor my susceptibility for making errors. The trader is in a constant state of self-awareness, watching for the old, fear-based patterns of thought to reemerge. They know that maintaining the right mindset is an ongoing process. I understand the absolute necessity of these principles of consistent success, and therefore, I never violate them. This is the commitment. The trader treats these principles as the sacred rules of their business. When a trader has fully integrated these 7 principles, they have reached the zone. They are in a state of flow with the market. They are no longer battling the market or themselves. They are simply executing their plan with a calm, detached confidence. Their results become consistent because their mindset and behavior have become consistent. The boom and bust cycle is broken because the underlying fear has been removed. Douglas ends by emphasizing that this is a journey. You don't just read the book and become a master trader. You must consciously and deliberately work to build this new mindset, trade by trade, day by day. It is the most challenging, but also the most rewarding work you will ever do as a trader. The ultimate goal is to achieve a state of mental freedom, where you are no longer a slave to your own emotions and can finally trade to your full potential. Modern takeaway. Achieving this state of mind is harder than ever in the modern world, but the principles are the same. A modern trader who thinks like a professional might have a very simple, objective edge. I will buy the S&P 500 ETF SPY when it closes above its 20-day moving average after being below it for at least 5 days. That is their objectively identified edge. They will predefine their risk. I will place a stop loss 2% below my entry price. They will completely accept that risk. And when the signal happens, they will click buy without hesitation, regardless of what the news is saying or what their Twitter feed looks like. They will have a plan for taking profits, perhaps selling half their position after a 5% gain. They will keep a journal to monitor their execution, and they will never violate this simple set of rules. This disciplined, process-driven approach is the polar opposite of the chaotic, emotional decision-making that is so common today. The trader who gets their ideas from a Reddit forum, who buys a stock because a celebrity tweeted about it, who has no predefined exit plan, that trader is not thinking like a professional. They are gambling. This final chapter is the ultimate blueprint. It is the operating manual for the professional trading mind. Whether you are trading stocks, options, futures, or cryptocurrencies, these 7 principles are the universal laws of consistent success. Modern context expansion. What would Mark Douglas say today? If we could bring Mark Douglas, the master of trading psychology, into the hyper-accelerated markets of the 21st century, his reaction would be one of profound validation. He would see our modern world as a perfect, high-fidelity demonstration of every psychological flaw he ever wrote about, amplified to a global scale. The modern casino, an environment built for psychological failure. Douglas would look at the modern trading interface, an app like Robinhood or a crypto exchange like Coinbase, and see the perfect architecture for creating gambling addiction. He warned about the dangers of random rewards, and these platforms deliver them with unprecedented efficiency. The zero-commission trades, the confetti animations for a filled order, the easy access to highly leveraged products like options and futures. It's all designed to provide constant stimulation and dopamine hits. He would be particularly concerned about the 24/7 nature of cryptocurrency markets. In his day, the market closed, giving traders time to rest, reflect, and emotionally reset. Today, a crypto trader can be tethered to the screen around the clock, never disconnecting from the P&L roller coaster. This leads to exhaustion, burnout, and a complete breakdown of disciplined decision-making. He would see this as a brutal environment that preys on our most basic psychological vulnerabilities. The influence of social media would horrify him. He taught traders to develop an independent mind, to see the market objectively. He would see platforms like Twitter, Reddit, and TikTok as giant machines for creating herd mentality and emotional contagion. The rise of finfluencers and anonymous accounts promising secret systems would be, in his eyes, a major source of the limiting beliefs that destroy traders. People are no longer just trading the market. They are trading the narrative, the meme, the community, all things that pull them away from the objective, probabilistic mindset he advocated. The system versus. The Mind Douglas's core message was that the system or strategy is only a small part of the success equation. In today's world, there is an obsession with finding the perfect automated system. Traders buy expert advisors, EAs, for Forex trading, subscribe to algorithmic signal services, or try to copy the trades of a YouTube guru. Douglas would say this is a fool's errand. He would argue that even with a perfect, profitable algorithm, most traders would still find a way to lose money with it. Why? Because they would not have the psychological fortitude to execute it flawlessly. After a string of 5 losing trades, a normal occurrence for any system, their fear would take over. They would start to doubt the system, manually override its signals, turn off, and then go searching for a new holy grail. He would stress, now more than ever, that you cannot buy success. You must build a mind that is capable of producing success. The system is a tool, but the trader is the operator, and a fearful operator will crash even the most advanced machine. Human psychology versus AI and quant trading. How would Douglas view the rise of emotionless quantitative funds and AI trading models? He wouldn't see them as a threat, but as the ultimate proof of his thesis. These algorithms are consistently profitable for one reason. They do not have human emotions. An AI model can execute its edge thousands of times without fear, hope, or greed. It mechanically follows its programming, letting the probabilities play out. It is, in essence, a perfect embodiment of the mindset Douglas was trying to teach humans to adopt. He would argue that for the retail, discretionary trader, this makes his work more critical, not less. To compete in a market dominated by unemotional machines, the human trader's only hope is to become as machine-like as possible in their own execution. You cannot beat the algorithms at speed or data processing. Your only chance is to beat the other humans by mastering your own psychology. The battle for the retail trader is not against the quants. It's against a flawed human sitting in the next chair, and most importantly, against the flawed human staring back from the mirror. His timeless principles are the shield. In a world of FOMO and hype, the 5 fundamental truths act as an anchor to reality. The concept of thinking in probabilities is the ultimate defense against the emotional roller coaster of watching your crypto portfolio fluctuate wildly. The discipline of taking responsibility is the only way to escape the echo chambers of blame that are so pervasive online. Mark Douglas would conclude that technology has made it easier than ever to trade, but it has not made it any easier to win. The path to success remains the same. It is an internal journey to conquer the battlefield of the mind. Closing reflection, 10 timeless lessons from the zone. As we conclude this deep exploration of Mark Douglas's Trading the Zone, we are left not with a trading strategy, but with a new way of being. This book is a manual for rewiring your brain to operate effectively in an environment of unlimited uncertainty. Its lessons are profound, challenging, and ultimately liberating. Let's distill its wisdom into 10 timeless lessons for any trader or investor. Your mind is your greatest asset and liability. The market is not your enemy. Your own undisciplined, fear-based mind is the only thing standing between you and consistent results. Stop trying to fix the market and start working on yourself. Anything can happen. Abandon the need for certainty. The market can and will do anything at any time. Truly accepting this eliminates the possibility of being surprised or feeling betrayed by the market's actions. You don't need to predict the future to win. Success is not about being a good fortune teller. It's about having a tested edge, a higher probability of one thing happening over another, and executing it flawlessly over time. An edge only works over a sample size. The outcome of any single trade is random and meaningless. Stop attaching your self-worth to it. Your edge will only manifest over a series of 20, 50, or 100 trades. Trust the process, not the individual outcome. Think like casino. A casino doesn't know the outcome of the next spin, but it knows it will be profitable over thousands of spins. Adopt this probabilistic mindset. A loss is not a failure. It is a normal, expected business expense. Take 100% responsibility. Stop blaming the market, your broker, or manipulators. The moment you accept total responsibility for your results is the moment you give yourself the power to change them. You are the cause of your own P and L. Every moment is unique. The market has no memory. Stop letting the pain of your last losing trade influence your decision on this one. Treat every signal from your system as a fresh event with a probabilistic outcome. The goal is consistency, not constant wins. You cannot achieve consistent results if your mental state is chaotic. The path to consistent profits is through a consistent discipline and objective mindset. Your beliefs create your reality. The market is neutral. Your beliefs about the market are what cause you to feel fear and greed. Identify your limiting beliefs and actively work to replace them with the 5 fundamental truths. Achieve a state of carefree confidence. The ultimate goal is to trade without fear. This comes from a deep, unshakable trust in your edge and in your ability to follow your rules, no matter what. How can you apply these lessons right now? The first step is awareness. Start a trading journal, and don't just record your trades. Record your emotions. What were you thinking and feeling when you entered, held, and exited each position? This will reveal the limiting beliefs that are driving your errors. Next, take your favorite strategy and define it with absolute, objective rules. I will buy when X happens. I will place my stop loss at Y, and I will take profits at Z. Then commit to taking the next 20 trades based on these rules, risking a small, fixed amount on each. The goal of this exercise is not to make money. The goal is flawless execution. Can you follow your own rules for 20 trades in a row without emotional interference? This is a practical exercise that builds the skill of discipline and the belief in probabilities. Mark Douglas's work is challenging because it forces us to admit that we are the problem, but it is also incredibly hopeful. It tells us that we have the power to change, to grow, and to create the mindset we need to succeed. The journey into the zone is a journey of self-discovery and self-mastery. It is the path to true freedom as a trader.